Cryptocurrency and stocks are two popular investment options that have gained significant attention in recent years. Both offer the potential for substantial returns, but they also come with their own set of advantages and risks. Hello viewers and welcome to our channel. Today in this video, we will explore the question of whether cryptocurrency is better than stocks and delve into various factors that can help investors make informed decisions. Investors often face the dilemma of choosing between cryptocurrency and stocks for their investment portfolio. While both asset classes can be lucrative, they have distinct characteristics that set them apart. By examining factors such as volatility, accessibility, regulatory environment, investment opportunities, risk factors, and more, we can gain a better understanding of their pros and cons. What is cryptocurrency? In the simplest possible terms, cryptocurrencies are digital currencies based on blockchain technology. The term crypto comes from the cryptographic techniques used to verify transactions. These techniques replace the need for one central intermediary, such as a bank, which proponents see as a major benefit of crypto. Crypto prices are also known for their volatility, which carries the risk of significant losses or potential for significant gains. If you're interested in taking the plunge, you'll certainly benefit from learning the basics to make the most of your investment. Once you have purchased cryptocurrency, you need to store it safely to protect it from hacks or theft. Usually, cryptocurrency is stored in crypto wallets, which are physical devices or online software used to store the private keys to your cryptocurrencies securely. What are the most popular types of cryptocurrencies? Before you get into crypto, you'll want to decide where to put your money. There are thousands of cryptocurrencies out there, and this list continues to grow each day, but there are some that are better known than others. They include Bitcoin, Ether, Ethereum, Tether, Solana, and Dogecoin. What are stocks? A stock, also known as a share, represents ownership of a fraction of a company. In many cases, the holder of the stock is often entitled to a corresponding share of the company's profits in the form of a dividend. Stocks are primarily bought and sold or traded on stock exchanges, such as the London Stock Exchange or the New York Stock Exchange. For many investors, stocks have long been an appealing investment. When a given company does well, so do the people who have invested in it. If the value of their investment increases, they have the option of selling it at a profit. Of course, companies don't always do well, so investors run the risk that their investment can go down in value as well. 5 key differences between crypto and stocks. So what are the major differences between cryptocurrencies and stocks? And what do these differences mean for you, as someone trying to make the most out of their money? Number 1. History. Stocks and stock exchanges have a long, distinguished history. The first stock exchange, the Amsterdam Stock Exchange, was set up as far back as 1611. The heavyweights of the London Stock Exchange and the New York Stock Exchange followed in 1698 and 1792, respectively, shaping the world of finance as we know it today. Since then, stock exchanges have established themselves as a pillar of our financial system. The London Stock Exchange alone has close to 1 million transactions a day, and the New York Stock Exchange experiences 2.4 billion shares change hands daily. For investors, stocks have generally offered reasonably consistent returns, although investments can fluctuate up and down. For instance, the average annual stock market return was 13.9% for the S&P 500 index from 2011 through 2020. Unlike stocks, crypto is very much the new kid on the block, having been around since just 2009. Starting with the publication of Satoshi Nakamoto's white paper on Bitcoin in 2008, cryptocurrencies have skyrocketed in terms of both public awareness and interest. Number 2. Price volatility. The term volatility refers to the extent to which an asset's price fluctuates over time. Highly volatile assets can experience big price swings, both upward and downward, whereas less volatile assets are likely to show more stability. So what's the difference between crypto and stocks in terms of volatility? Generally speaking, the uncertainty about the future value of cryptocurrencies and the fact that they're often not backed by physical assets means that they're usually considered more volatile than stocks. And since the crypto market contains a number of crypto whales, people or companies who hold a very large amount of a particular coin, these become more vulnerable to investors' actions. Keep in mind, though, that even investments that are considered less volatile, like stocks, can experience unexpected periods of volatility. Number 3. Regulation. Most stock markets around the world are subject to governmental oversight. Administrative bodies, such as the Securities and Exchange Commission, SEC in the U.S., have wide-reaching powers to investigate and punish any wrongdoing. These protect both investors and the market at large, ensuring, as the SEC puts it, that people who seek your investment dollars must tell you the truth about their businesses. And people who sell securities must treat you fairly and honestly, putting your interests first. And they're not shy about cracking down on wrongdoers either, with one of the SEC's heaviest fines to date being $13 billion levied against JP Morgan Chase for its role in the recent financial crisis. Unlike stocks, the crypto market can be a bit of a Wild West. It's a system that prides itself on its decentralized, unregulated nature, so it's hardly subject to the same levels of regulatory oversight. Governments are currently grappling with the issue of aligning cryptocurrencies with their existing financial systems. The Chinese government, for example, recently banned all trading and speculation in cryptocurrencies, or virtual currencies. And even the IMF is calling for extensive, far-reaching regulation of crypto to protect investors from the volatility of the market. Number 4. Scams and security risks. Cryptocurrency markets are evolving and growing at a rapid pace, and this, combined with their largely unregulated nature, means that they are a hotbed for scams of all kinds. These scams often revolve around attempts to obtain people's personal data, such as the codes required to access an individual's crypto holdings, or attempts to have investors transfer crypto to scam artists who might be impersonating legitimate entities. The U.S. alone had more than 80,000 reports of crime involving cryptocurrencies in 2021. Stocks aren't immune from scams and security risks either. One of the most well-known stock scams is the pump and dump, where a stock's price is artificially inflated by highly exaggerated statements encouraging investors to buy, before the orchestrators of the scheme sell their holdings at a much higher price. There are all kinds of other stock scams too. Remember Bernie Madoff? His Ponzi scheme duped investors out of an estimated $50 billion back in the early 2000s. Number 5. Diversification. If you choose to invest in stocks over crypto, you can select from companies in practically every sector and every country in the world. You can be a shareholder in the Japanese automobile industry or in US-based tech companies, and everything in between. This allows you to put together a highly diverse portfolio that isn't fully dependent on particular industries or geographical markets. In turn, this can help reduce your risk of losing everything. While there are many different types of cryptocurrencies, more than 16,000 as of January 2022, according to CoinMarketCap.com, and various kinds of crypto assets, such as NFTs to choose from, there are fewer options to diversify with crypto than with stocks. While you can reduce risk by making sure you don't buy just one type of crypto coin, there's really no easy way to fully diversify your investments. This leaves you in a riskier position if you put all your money in one type of coin or in a small handful of them. Should I invest in crypto or stocks? As you can see, cryptocurrency is a riskier investment than stocks. However, it also has the potential for higher returns. Stocks are a more stable investment, but they offer lower potential returns. Ultimately, the decision of whether to invest in cryptocurrency or stocks depends on your individual circumstances and goals. If you are looking for a high-risk, high-reward investment, then cryptocurrency may be a good option for you. However, if you are looking for a more stable investment with lower potential returns, then stocks may be a better choice. If you are still unsure whether to invest in cryptocurrency or stocks, it is a good idea to speak with a financial advisor. They can help you assess your individual circumstances and goals and recommend the best investment for you. So this was our today's video. I hope you all like it. Don't forget to hit the like button and subscribe the channel, and share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.